Nvidia and Palantir, two of the hottest stocks in the entire stock market right now. And it's really not that hard to see why. Since November of 2022, so that's 2 years ago, Nvidia is up 800 to 900%. That's insane returns. That's life-changing returns. And Palantir is a very similar story. Since the middle of 2023 to now, the stock is up 600 to 700%. Once again, if you invested at the bottom, these are life-changing returns. As always with investing, when a stock shoots up to the sky like this, there's always loud voices that start to come up from the media and your surroundings. And there's one side of these voices that's telling you sell while you're up, the risk is high now, and the money is done and you don't want to lose your money if the stock goes down. The other side is telling you that these stocks are still cheap and that these companies are going to grow very fast and that we're in the early innings of AI and there's a lot of money to be made still. And the question is, how can both views that are so opposite be true at the same time? Is one side right and the other side wrong? But like anything in life, nothing is black and nothing is white. It's all a spectrum. And the answer for you specifically lies somewhere in the middle, depending on your investment needs and objectives. Now, both of these companies, Nvidia and Palantir, have benefited tremendously from the AI revolution, and they're pretty much the ones that are fueling this entire change in AI. On the one hand, you have Nvidia that's basically responsible for building all of the infrastructure in the world that underpins any type of AI application. And on the other hand, you have Palantir, a software company that is an expert at taking extremely large amount of data and finding industrial applications for them in any type of industry, from healthcare to the military, counterterrorism, manufacturing, etc. And that's the end goal of AI and capitalism, really. It's to find use cases for large amounts of data so that corporations can find efficiencies, make more money, and fill their pockets. So with all that being said, in this video, we'll be looking at each of these companies one by one and establishing what are the opportunities and risks based on all the facts that are out there and that we know. If you're new here, let me give you a quick introduction of what we do at RatedA. We look at the stock market from a fundamental value perspective. Now, what does all that mean? In the simplest of terms, it just means that we buy businesses, we don't trade stocks. And the whole point here is to buy great businesses and find great companies that we can buy, acquire, and hold for the long term while they create value and share some of that value back with us, the common shareholder. That's the essence of fundamental investing, really. But finding the best businesses in the world is just not enough. We also have to pay a fair price and reasonable price in order to enjoy an acceptable rate of return. For example, let's say you pay $1 million in order to buy $1 of yearly free cash flow. 1 million for $1. That's terrible. Even if that $1 grows enormously to $100, that's still a horrible return. That's a horrible investment, right? If you pay $1 million to have $100 per year, that's a horrible investment. So the whole game of investing is to first find great businesses. And I would say that's 80% of the hard work, identifying those businesses that are worth holding on for the long term. And then you have to be able to value them accurately, but not precisely. All that means is that it's better to be right directionally or to be approximately in the good direction than to be wrong absolutely, to have a very precise answer of what a company is worth, but to still be way off. And I would say this valuation exercise is about 20% of the game. And the reason why that's so important is that you're trying to avoid massively overpaying for a company and experiencing a 70% drawdown just because you paid too much. Because at the end of the day, that's what interrupts the compounding process that happens over the long term. So ultimately, if you get those two things correct, the identifying the right business and paying a reasonable price, that's it, my friend. You've cracked the code. So let's get started right away with Nvidia. And if you're really interested in this company, there's a whole analysis that's written on the RatedA platform. Feel free to go check it out. There's a very common proverb that goes like this: when there's a gold rush, sell shovels. Well, in the gold rush of AI, Nvidia is not only selling the shovels, but they're selling the pickaxes, they're selling the maps to find the gold, they're selling the entire encampment where people are staying in order to go dig out the gold. In other words, without NVIDIA, pretty much every single AI use case would fail to exist. So let's go through a quick overview of what NVIDIA does and how they make money. The GPU here, which stands for Graphics Processing Unit, is the basis of NVIDIA's entire success as a company. I'm not afraid to say it. What a GPU does is that instead of processing information in zeros and ones linearly like a CPU, GPUs have many little parallel processors, and so it can process information in parallel, so many different processes at once. And this is extremely useful for workloads that don't require a lot of processing power but need to be done simultaneously. So for example, graphics of video games. So actually, NVIDIA's first market for its GPUs was video game creators. But obviously, being able to process all this information in parallel and simultaneously is also very important for workloads that have lots and lots and lots of data, aka algorithms and training of AI. So when you think about today's world and AI, you think of large language models, you think of social media algorithms, even targeted ads. All of these things are built on top of GPUs, and most likely NVIDIA GPUs. So GPUs are really the base of all of NVIDIA's hardware. But then, like we can see here, there's CUDA, C-U-D-A. That's the software that goes on top of the hardware in order to develop all these AI applications. So say in the healthcare industry, when a pharmaceutical company is trying to test different molecules and how they bind to receptors in order to find a new drug, they'll need to develop an application for that. And that's done through NVIDIA's CUDA libraries. The next big component of importance here is the NVLink, switch and spine. So a few years ago, NVIDIA acquired this company called Mellanox. And Mellanox pretty much creates circuits that connect GPUs to each other in a data center and allows them to communicate really efficiently. And so with all these little pieces of hardware, NVIDIA owns all of the architecture that the big cloud providers like Microsoft, Amazon, and Google are using to build their data centers with. All of these giant companies, which realistically are the richest companies in the world, are rushing to buy components from NVIDIA, build these data centers in order to develop their own businesses. Now, as you can imagine, NVIDIA's business is very sticky. When a company like Microsoft uses NVIDIA hardware and NVIDIA's CUDA in order to build on top of that hardware inside of their data centers, it's very hard to switch to a different provider. Once you start building a data center with some components, you need the other components to pretty much match with what's already in the data center. Then there's all the story about, developers knowing how to use CUDA and that becoming the standard to code AI applications. And so NVIDIA is managing to little by little carve out a very important moat for itself so that competitors won't be able to come in and take away market share. That's super important. And as of today, NVIDIA is a monopoly in this market. The only company that is somewhat competing in the same space is AMD, but they're nowhere close to what NVIDIA is currently able to offer. And as you can imagine, with all these new AI businesses starting up and everyone investing in AI, the big cloud providers are rushing to buy NVIDIA's components and to expand their architecture. And obviously, this stands very well for NVIDIA because their total addressable market is just growing. So as of today, NVIDIA derives around 80% of its revenues from data centers, so that's selling to cloud providers like Microsoft and Google. 17% comes from gaming, which we talked about, the GPUs are used for graphics. And then a very small portion of revenue comes from professional visualization and automotive. Now, these are very small today. The hope is that they'll increase in importance as time goes on. But let's be honest. Clearly, with Nvidia, the opportunity is in the growth, the profitability of this company, which is simply extraordinary. You don't see charts like this every day. If we look at the revenue in the first half of 2025, it's almost as much as all of full year 2024. So realistically, we can expect Nvidia to double its revenues in 2025, at least double. And similarly, we can say the same about free cash flow. The company made more in the first half of 2025 than it did in all of 2024. So, in very simple terms, this is the opportunity with Nvidia. It's the growth. How far can this growth go? How much will companies want to invest in AI? Because as long as people want to go find that gold, Nvidia will provide the shovels and get rich in the meantime. But we can't just focus on the opportunity and ignore all the risks. If you do, then you're just lying to yourself or trying to convince yourself that this is a good idea. And in investing, you don't want to convince yourself of anything. You want to look at all the probabilities and make an informed decision based on that. The first risk that comes to my head is cyclicality. Semiconductor chips have always been a cyclical product. All these semiconductor firms, they just produce chips because the demand is really high. And when the demand drops, then they end up having all this inventory of chips that they can't sell, which leads to a drop in revenues. And we can see this happened in 2022 for Nvidia. Their free cash flow went from 6 billion to 1 billion in the span of 1 year. So again, this is a short-term risk, maybe not something for a long-term investor, but still something to keep in mind. Because as we can see, demand can shift quite drastically from 1 year to the next. This resulted in a decrease of 60% in Nvidia's share price. As a long-term investor, you might say, sure, that's not a big deal. I'm just going to hold on to the stock for 10 years, 15 years, and the returns will take care of themselves. But let me tell you that when you see a 60% drawdown in your portfolio, it's not all that easy to keep conviction in that stock. It's psychological. The second risk with Nvidia is competition. The likes of Meta and Google are all trying to find ways to cut Nvidia out of the supply chain and develop their own chips so that they don't have to rely on this monopolistic player. And the semiconductor and overall tech space is a very quickly evolving landscape. It's not like you're selling candy and you know that people will still want to buy candy 15 years down the line. 3-4 years ago, very few people could have seen that LLMs were going to come onto the scene and that Nvidia was going to become such an important infrastructure player. So what's to say that these conditions are going to stay the same in 5 years or 10 years? Then there's also the fact that Nvidia has a highly concentrated client list. When you think about it, all of Nvidia's clients are the big tech players, the Metas, the Googles, the Apples, the Amazons. These companies are the only ones that can afford to buy lots of Nvidia chips, but they're also the companies that want to kind of compete with Nvidia. So lots of things to consider. Now we know what the opportunity and the risks are. There's no question about it. Nvidia is a very high quality company. Over the long term, these are the types of companies that I want to have in my own portfolio. But remember, we have to look at the price and pay a fair price in order to have an acceptable return over the long term. Right now, Nvidia has a 3.5 trillion market cap and is selling at $145 per share. So what's implied in that? Last year, the free cash flow was $1 per share. This year, it's likely to be around $2 per share. But considering the price of $145 per share, the market clearly is expecting Nvidia to reach $5, $6 per share in the next 2-3 years. The keyword in what I said is expecting. Now, if we're going to speak in objective terms, I think that most value investors would pass on Nvidia at today's valuation. That's because traditional value investors look for low hurdles. When you're expecting a company to 4x its free cash flow to justify today's price, that's not a value bet anymore. Moving on to Palantir. This company isn't covered on RatedA since it doesn't pay a dividend, but since it's been covered in the media so much since the stock price has gone to the moon, I thought it would be nice to give my quick take on it. Palantir keeps its operations kind of secret, kind of obscure, maybe for national security reasons. But in essence, what this company does is it takes extremely large data sets and finds a way to make it profitable or useful for corporations and governments. This company used to sell exclusively to governments, but in the past few years, they pivoted to more commercial revenue sources, and now it's about half and half. From the little amount of research that I've been able to do on this company, it's a wonderful company. It's got a really powerful moat in the sense that it has lots of switching costs, and we can see here that the customer count just goes up in stepwise fashion. Once a company or a government starts to work with Palantir, most likely it's going to stick with Palantir for a very long time. And Palantir doesn't really have many competitors. It's one of the only companies that does what it does. Now, on top of that, the company is highly profitable. It's highly scalable in the sense that it grows along with the companies that are its customers. The way it bills its clients is by usage. So when a company grows and starts to use Palantir more and more, Palantir gets more revenues in return. It's subscription based, which means that it's recurring revenue as well. And all in all, considering that they're an AI company and they're looking at large data sets, most likely they have a super long runway for growth. And we can see that in the revenues that are growing extremely consistently year after year after year. Just like Nvidia, there's no question that this is a very high quality company that I would like to own for the long term in my portfolio. But we also have to look at the share price and to see what's implied in the valuation in order to guide our investment decisions. The company's market cap today is $134 billion. That's how much it would cost to buy the entire company of Palantir. We know that free cash flow is the most important metric to look at in valuation. We can see that in the past 12 months, the company has done pretty much 1 billion of free cash flow. Something I always look at though is stock-based compensation, and this is quite disappointing. Out of the $1 billion of free cash flow that the company brought in, half of that came from share-based compensation. This is cash that the company is raising by issuing more shares and diluting the current shareholders. So realistically, the company is only making about $500 million in free cash flow. I don't need to paint a picture for you, that's just extremely expensive relative to the market cap. What it means is that on the current share price, the market is assuming and expecting Palantir to pretty much multiply its free cash flow by 10x in the next few years. That's what's implied from the current share price. Remember that no matter how high the quality the company is, if the price is too much, you're just not going to get that intrinsic return from owning the company. The share price could still go up based on speculation, but that's not value and fundamental investing. As a matter of fact, it kind of reminds me of what I saw with Snowflake back in 2021. This is one of the highest quality companies I've ever seen. The whole market knows it, but the valuation on IPO was so high that the company has gone nowhere in the past 4 years. And this is despite growing revenues from $500 million to $3.2 billion. And also the free cash flow from the negatives to almost $1 billion. So now I want to go back to the original premise of this video. Is it too late to buy Palantir and Nvidia? Has the train already left the station? Or is it still early days? Well, as you can probably tell from this video if you're still watching, that's not the correct way to think about things if you're a fundamental value long-term investor. Instead, you have to ask yourself two questions. Is this company high quality? And in this case, both Palantir and Nvidia tick that little box. Both are very high quality companies. Then you have to ask yourself the second question. At this share price, if I invest right now, am I going to get a good return from that? At the end of the day, the answer to that question will all depend on the assumptions that you're making for your valuation model. Right now, the current stock price is indicating that the market is expecting these companies to double their free cash flows for the next 3, 4, 5 years. That's the benchmark that you need to hit. If you're a value investor, which some of you will be, that's just too high of a hurdle to jump over. That also doesn't mean that you have to sell the shares at these levels if you own them from previously, especially if you're a quality investor. I'm sorry that I wasn't able to give a simple yes or no answer to any of these questions, but at the end of the day, that's not how investing works. And that's the beauty of it.